the stock markets. Trading. Immediately, images come to mind. And what we've found is that more often than not, the images are negative. Images of gambling crop up. We begin thinking of those who gambled away their money in the share markets. You probably have a friend or two who've gone through that. It's a fool's game, they say. But then again, we hear about investors making millions, sometimes even billions of dollars. How is that even possible? And how can there be so much disparity in this spectrum? On one side, you have investors thinking why the market fell, losing a small fortune and cursing the markets. And on the other side, you have investors making millions like Warren Buffett, Ed Seykota, Paul Tudor Jones. The list goes on and on. The question comes down to this. What can you do to make sure that you win in the markets like they have? Well, that's where Trade Academy comes in. And what you can do with your money, you can find out here. Now, without a doubt, India is growing and growing fast. It's one of the fastest growing countries in the world. But here's something weird. In the US, you have over 40% of the population investing in stocks. And in India, it's less than 2%. 40% and 2. Isn't that just a bit weird? You need to think of this course like a journey. We're going to start with nothing, we're going to assume nothing, and we're going to build those foundations brick by brick. So instead of learning how to buy and sell a stock on a computer straight away, we're going to learn what a stock actually is, how it becomes a stock in the first place. And then we're going to move on to more advanced concepts. But first things first, this lesson is going to be about misconceptions. So we're going to learn about all those things that make things fuzzy and confusing, and we're going to shatter those misconceptions. Okay, so let's start with the stock market returns, right? You've probably heard of Sensex and the Nifty. You've probably heard your mom or dad or a friend talk about the Sensex go up or down, or the Nifty go up or down. So what are they? You've probably heard about them on TV or in the newspaper you read. Now, the oldest stock exchange in Asia is the Bombay Stock Exchange, or the BSE. And there lies the home of the Sensex. Now, what is the Sensex? Over 5,000 stocks are listed on the Bombay Stock Exchange. That means you and I can buy stocks on the BSE, and there are 5,000 of them. That's a lot. Now, on any given day, some stocks are going up and some are down. How do you track so many stocks? Well, that's the reason an index was created, like the Sensex. The Sensex is nothing but an average of 30 big companies. The biggest companies in India, they're all market leaders. You've probably heard a few of them. On the Sensex, some of the companies are Tata Power, NTPC, Maruti Suzuki, Cipla, and State Bank of India. So you've probably heard of Maruti Suzuki. It's the cars you drive in, the medicines you buy from Cipla, and the bank accounts at State Bank of India. Now you need to remember one thing. The Sensex is an average of the 30 biggest companies of India. These are just a few. As of 5th January 2014, the Sensex value was at 27,887. Now that's really nice, but what about returns? So here I have a chart, and you'll see that from 1994 all the way to 2000 and then to 2014, we can see the returns of the average of these 30 stocks. That is the Sensex. So if you invested in 1994, that year got you a 14% profit. And then a minus 20% after that, and then all the returns are right here. Now, here is something very interesting. How much would you actually earn if you invested in the markets? We have some outstanding years like 2009, which is 80%. We have some outstanding years like 2003, which is 72%. And then we have really bad years like 2008, minus 52%. So from 2001, for example, all the way to here, 2014, your average return for all these years would be an average annual return of 21%. That is unbelievable. 21%. Now that's a number you need to keep in mind. But let's see this from a practical perspective. People don't normally buy the Sensex ETF or buy the Sensex. They invest in individual stocks like Reliance, Hindalco, Tata Steel, or any of those companies. So let's go back. Let's go back to 2005, 10 years from now, and imagine we're investing 10 lakh rupees in the 10 biggest companies of the Sensex. So let's see what that looks like. Those companies were ITC, NTPC, ONGC, Hindalco, SBI, HDFC Bank, ICICI Bank, HDFC, Hindustan Unilever, and Reliance. So you have 10 lakh rupees and 10 companies, so that's 1 lakh each. Now, the question is from 2005 to the end of 2014, how much is that 10 lakhs now worth? Take a wild guess. How much do you think the value has appreciated? 20, 30, 40? Well, it's actually 68 lakh rupees. That is staggering. But here's something more into the equation. If you add tax benefits, if you are holding a stock for more than 12 months, it is completely exempt from income tax if you've made a profit. So this 68 lakhs that you've made, which has grown to 68 lakhs rather, the profit is completely exempt from income tax. This is very different from, say, a fixed deposit, where if you do make money from the fixed deposit, you will pay 30% income tax if you fall in that slab. We're going to go around Mumbai and ask people what they would do if they had 50 lakhs in cash. Would they invest in property, gold, FDs, or stocks? Let's find out. What would you buy?
Probably I would buy a house.
A house.
Yeah. Of course, land mein.
Mainly in gold.
Right.
I will prefer first in the gold and then in the property actually.
Okay.
फिक्स डिपॉजिट में बैंक पे भरोसा होता है, ब्याज मिलता है.
Acha.
Right now, we consider me equity is the best option for me.
So investment in property is a pretty big deal. And why shouldn't it be? You can live in it and it's safe. And well, it's property, right? So tracking returns on property is slightly difficult. So what we did is we took the top best cities in India, the top 10 cities in India, and figured out the average return. It comes out to be 50% for the last 5 years. So your investment of 50 lakh rupees would grow to about 73 lakhs after tax adjustment. That is actually a very good return on investment. We Indians love gold, don't we? Well, it's considered a safe investment and you can touch, feel it. And like that lady said, she can wear it too. Well, the average return on gold during this time was actually 46%. So it was not as good as property. Your 50 lakhs would have grown to about 71 lakhs. That's not bad at all. Fixed deposits. Now, they are a very safe investment. You keep it with the bank. You know exactly how much money you'll earn after it matures. And of course, it's very convenient. You could do it on the phone or even online. Now, there's one serious disadvantage with FDs that most people don't know. If you're in a tax bracket, you will be taxed. So if you're at the 30% slab, you need to subtract that. Now, the average rate over the last 5 years for an FD was 7.5%. If you minus the 30%, your 50 lakh investment is just worth about 64.5 lakhs. Much, much lower than the gold and houses counterpart. Now, finally, we have stocks. Now, instead of investing in individual stocks, we look at the Sensex. It doubled from 2010 to 2014, going from 14,000 to almost 28,000, my friend. That is a 100% increase. Now, your investment of 50 lakhs would be worth roughly 102 lakhs during this time. And there is a tax advantage. If you hold stocks for more than 1 year, it is completely exempt from income tax. So we learned two things from this, that during this period, the best asset class was stocks, and you have a huge tax advantage. Now, despite comparing against all asset classes and seeing the good rewards of stocks, one question will keep bothering you at the back of your mind. And that is, what if the stock market crashes? And it's a very valid point. After all, in 2008, the stocks did crash. The Sensex did, Nifty fell, all major indices did. It was a global meltdown. It was the subprime crisis. And it also did back in 2000 as well, the dot-com bust. So if you remember, when we looked at that grid of Sensex returns, 2008 was a huge loser. What if you were caught up in just that mess? Now, you will learn a lot of methodologies at Trade Academy to avoid such issues, but let's capture this problem head on. Let's hit the nail right on the head and see what will happen in a worst case scenario. What if you invested 2 months before that crash? This is the chart of BSE Sensex. Now, don't get too scared. It's very simple. This is the date line, so this is time moving forward. And this mountain move up, this is price. So the Sensex has gone from 4,000, somewhere here, that's back in 2003, all the way to 20,000 in 2007. So this is over a long period of time. Now, this is what the market looked like in 2007. Here it is now. You invested somewhere here in October. Let's say that amount is 55 lakhs. Now, usually at such points, the market moves up really quickly. And we went all the way, and at this point, that's the tip that you see here, your investment was 69 lakhs. Then something interesting happened. Now take a look at this. I'll fast forward about 1 year. That was the point that we were talking about. And then the crash came. That was the subprime crash. And all hell broke loose. We went from 20,000 all the way down to the lower 10,000s. Scary, right? Now this is where most investors would jump ship. They would exit. So your original 55 lakhs is now valued at just under 33 lakhs. Ouch. But let's say that you held on to your investments. I'm going to fast forward a little ahead. As you can see, we got a little bit of recovery going ahead, some more, and finally we can go much further into the future, and you'll see that that was the crash back then. You held on, and the markets are here much higher from that so-called crash and gambling people talk about. Your investment is now valued at 90 lakh rupees, almost a crore. That's not bad at all. And what's interesting is that this was the worst case scenario. The methods you learn at Trade Academy is going to make you a better trader and investor. So you don't have to see such things. But remember, even in the worst case scenario, you still came out a winner. Now that was amazing. That was the BSE Sensex, the index which moved from one end to the other. It was reflecting a very natural movement in the economy that was happening at that time. Now, markets, just like the economy, go through boom and bust phases. So you have times when the economy is contracting, where you see depression, and you also see euphoric times when the stock market keeps going up. This is a very natural cycle that happens in all economies all over the world. What you need is two schools of thought, two techniques, two methodologies. One is fundamental analysis, which basically looks at markets in the form of financials. So you look at companies and their valuation. On the other hand, you have technical analysis, which believes in price action. So you look at areas of demand and areas of supply. Using both of these schools, you can actually find out areas of contraction leaving or areas of euphoric times coming in. Now, let's see something more interesting. That was an index, right? Let's look at some individual stocks. And I promise you, this is very interesting. Now, what we saw previously was the Sensex. But these are companies that form the Sensex, some of the 30 companies. So this is ACC. As you can see over here, this is again price. So this is the market crash, so to speak. Well, that fall, we're actually over here right now. Let's look at another example. Over here, Ambuja Cement fell from 150 all the way to 50 rupees. It's trading at 227 now. That's beautiful. But then you get the occasional and quite frequent Asian Paints. That you see, that small blip, that's the crash. And we went from 140 rupees per share to about 60 rupees per share. That's quite a crash, but from 60 rupees, we are now trading at 750 rupees per share. Similarly, you can see all these other stocks moving up. There's something here, there's something very interesting. Occasionally, you will get the Cipla, which has moved fantastically upwards, and stocks like DLF. Now, DLF has not been able to recover. It's fallen from 1,050 per share and still today trades at 137. You're not going to get all winners. That's not going to happen. But overall, you will be profitable. Look at Dr. Reddy's, for example. You will get that as well. it's gone all the way from the crash point of 400 to 3,400 rupees per share. That just blows away your mind. No matter how many times you look at any mania, one thing is always certain. Those who are not making their own self-informed decisions will lose. And those who make their decisions based on a proper methodology win. Now, this is a chart of the typical market cycle. Now, it's not the same every single time, but it'll give you an idea of the psychology. In this area, you have smart money and institutional investors coming in. This is where professionals accumulate and buy stock. You have domestic institutional investors, mutual funds, insurance corporations, and foreign institutional investors. As the markets start to run up, more and more individuals join in. These are usually seasoned professionals as well. And then is the enthusiasm and greed phase. Now, that is the part where you have irrational exuberance. People buy because it's in fashion, people trade stocks because other people are trading as well. When the crash happens, you will notice that these individual traders who are making easy money, they curse their luck, file for divorce, and do all sorts of insane things that are normally not done. The professionals calmly wait and start to accumulate, and the cycle repeats itself. As we've seen for ourselves in this lesson, investing in the stock market is a pretty good option. Take a look at these market mavericks. They've been investing successfully for decades. This is Warren Buffett, perhaps the most famous investor of all time. This is Ramesh Damani, famous for foreseeing industry trends. And then there is Paul Tudor Jones, who uses a mixture of technical and fundamental analysis. And how can we forget Rakesh Jhunjhunwala? All these investors are billionaires, and they've invested in long-term trends. So now that we've got the misconceptions out of the way, let's learn what a stock actually is. In the next lesson, we learn this through the example of Raj. You see, Raj makes the best sweets in Bombay, and he takes this to an entrepreneurial leap. He starts one sweet stand and grows his business to such an extent that he takes the decision to list on the stock exchange. I'll see you in the next lesson.